Business Consulting Wellington, helping SMEs with productivity and growth by design. But first we're going to talk about finance systems. So the finance systems in your business. Many would put finance at number 7 in a 7-part system, but I put it as number 1 because how you set up your finance systems determines everything. For example, there's a client I've been working with recently who asked me to come in and help them with their marketing, their online presence and SEO. So in order to know how to target their business, I had to look at how many business units or divisions they had within their company, because they had a lot of different divisions of what they did, but they weren't categorized properly. In order to market them, you need to understand each category well. And then, of course, I had to, in order to know which order to put them in, priority of marketing, I had to understand which were the more profitable or not profitable categories. There's no point in me trying to turn a business around if I start marketing divisions or categories that are losing money. So of course, I had to go to the finances. So all roads lead to finance, basically. This is one example. Understanding how your finances are operating within the business will drive your focus and your business choices. A good understanding and organising of your business finances is the easiest and simplest way to substantially increase your profits, and you can do this without making any additional sales. Well-organised finance systems and analysis give you power within your business, basically clear insights into your business. It will show you directly what is working and what isn't working. It's a perfect measurement and control of your business performance and the right information for the planning process. Setting up your business finance systems the correct way will give you a far-reaching, versatile, powerful tool to drive every aspect of your business. As a business manager, you need to be versatile with your finance tools. So you've got your profit and loss statements, your balance sheets, your cash flow statements, operating budget, and key ratios. So P&L is often what the accountant will set up, is the thing they're most interested in, especially for year end, because then they can assess your depreciation, your provisions, and hence your tax liabilities in the year. I'm very interested, often very interested, first to understand your cash flow statements and your cash flows within different divisions, key ratios, and of course your balance sheets and your operating budget. And of course trend analysis is essential to understand, whether it be seasonal trends, weekly trends, or client funnel trends, prospect trends, the conversion trends. All these things are very important to understand. And the more you understand them, the more interesting this becomes. You'll start to love it. So finance systems could end up being the most exciting part of your business. You'll love it. The profit and loss statements typically show the financial performance of a business over the period of 12 months. There are 3 key numbers that could skyrocket your profits, and they are your revenue, your direct cost of sales, and your overhead. So I'll give you an example here. Here's a business where their revenue is about 1.8 million in gross sales. The direct cost of sales is 1.1 million, and so it's your variable costs or costs of gross sales. And in your gross profit or contribution, in this case, is your revenue minus your direct cost of sales, which is $760,000, giving you a percentage of sales of 41% gross profit. Now, I prefer the word contribution. It's not a profit, it's a contribution towards the cost of your overhead, which is your cost of running the business. So it's a sales less direct cost of sales. Now we're looking at your operations costs. So the overhead here in this case is $600,000, just under. So if we take that off the 761, we have $162,000 profit. Now that's your net profit, and that in this case it's a net profit of 8.7% of your revenue. Now if we just change those 3 key numbers by 5%, this is what happens. Your revenue goes from 1.8 million to 1.9 or 1.97 million, which is a $93,000 increase. Your direct cost sales, if we reduce the cost of sales by 5%, you reduce it by $55,000, giving you a gross profit of $910,000, which is an increase of $149,000. So your contribution has increased, meaning your contribution or gross profit ratio has gone from 41% to 46%, an improvement of 14%. And your overhead now, if we reduce that by 5%, we go from just under 600,000 to 570 odd, reducing it by near enough $30,000, giving you a net profit increase from 162 to 341. Now that's just over 100% increase. So by changing those three numbers by 5%, you're getting a 100% improvement in your profits from 8.7% to 17.4%. Now I think that's pretty amazing. Now let's say you did that without increasing the sales. You'd still affect the bottom line. And the other point here is that reducing your costs isn't always about renegotiating the cost of supply or firing staff or cutting things out. Most small companies will find 5% or more than 5% in improving efficiencies and processes, wasted activities and so forth. So it's actually much easier to find this than you might realize or than you might think. So next I'm going to talk about strategy in my next video, and click on the link below and learn about that.